Welcome to the Deep Dive. Today we're tackling maybe the most recognized name in market indexes, the Dow Jones Industrial Average. You see the headlines constantly. And right now, the Dow just smashed through another massive milestone. On October 1st, 2025, it closed at a record high, 46,441.10.
Yeah, it's a huge number. And what's really interesting is it happened despite, quite a bit of turbulence. We've got a government shutdown going on, other macro stuff.
Exactly. So today, we're going deep. What is this index? How does it actually work, especially with that quirky structure it has? And why is it hitting records now? Welcome to everything you need to know about finance.
And just a quick reminder before we jump in, this is all for informational purposes, sort of a learning dive. It's definitely not financial advice.
Right. And hey, if you find this kind of breakdown interesting, please do hit that like and subscribe button. It really helps us out. Okay, so let's start basic. The Dow, it's 30 big U.S. companies, right? But it's different.
It is. It tracks 30 prominent U.S. large-cap companies, and it's old, one of the oldest out there. Charles Dow and Edward Jones kicked it off way back in 1896.
Wow, 1896.
Yeah, and importantly, it doesn't include transportation or utility companies. They've got their own separate Dow averages.
Okay, here's the part I always find fascinating, the price-weighted paradox. Most indexes we talk about, like the S&P 500, are weighted by market cap, right? Size matters.
Correct. Bigger company, bigger influence.
But the Dow doesn't do that.
Nope. The Dow is purely price-weighted. That means the actual dollar price of one share is what determines how much influence that stock has on the index value.
So a company's total size, its market cap, is irrelevant.
Completely irrelevant to its weighting in the Dow. It's all about the stock price per share. And yeah, that's the fundamental point critics always bring up.
Can you give an example? Because that sounds counterintuitive.
Sure. If you look back and say March 2025, Goldman Sachs had the highest weighting. Why? High stock price.
Even though its market cap wasn't the biggest?
Right. Goldman's market cap was around $167 billion. Significant, sure, but compare that to Apple.
Sure.
Apple, around the same time, had a market cap of like $3.3 trillion, a giant.
Massive.
But because Apple's share price was lower than Goldman's, it actually fell outside the top 10 components in terms of weight.
So a $1 move in Goldman stock shifts the Dow more than a $1 move in Apple stock.
Exactly the same. A dollar move is a dollar move regardless of the company's overall value. Well, it's a historical quirk.
How do they even calculate the final number then? And what stops it going haywire if a stock splits or they swap a company out?
That's where the Dow divisor comes in. It's a crucial piece. Basically, they add up the prices of all 30 stocks.
Okay.
And then they divide that sum by this special number, the Dow divisor. As of late 2024, that divisor was around 0.16.
A weird number. What does it do?
Its job is to maintain consistency. Every time there's a stock split or a company is added or removed, they adjust the divisor so the index level doesn't suddenly jump or crash just because of that change.
So it smooths things out, keeps it comparable over time.
Precisely. It ensures the index value today means something relative to its value years ago. And right now, with that divisor, a $1 change in the price of any of the 30 stocks translates to about a 6.15-point move in the Dow index itself.
Got it. So who picks these 30 companies? Is it set in stone?
No, definitely not set in stone. There's a committee, folks from S&P Dow Jones Indices and the Wall Street Journal. They decide.
And they make changes.
Oh, yeah. The list has changed 59 times since 1896. They try to keep it representative of, prominent U.S. companies.
Have there been any big changes recently?
Absolutely. We've seen some major ones reflecting shifts in the economy. Just in November 2024, huge news, NVIDIA replaced Intel.
Wow, the AI effect right there.
Totally. And Sherwin-Williams, the paint company, replaced Dow Inc. And earlier in 2024, Amazon finally got added, replacing Walgreens Boots Alliance.
So it does adapt, albeit slowly.
Yeah.
But with only 30 stocks and this price weighting, it must be pretty concentrated, right?
It really is. As of May 2025, the data showed the top 5 stocks made up over 31% of the index's weight.
Over 31% from just 5 companies.
Yep. And the top 10 accounted for more than 53.79%. So, yeah, it's definitely concentrated compared to broader indexes.
Okay, so concentration, weird price weighting. It sounds flawed, but you hear people say it still tracks the market pretty well.
That's the really interesting part. Despite all the valid criticisms of its methodology, statistically, the Dow shows a very high correlation with the S&P 500.
Seriously, how close are we talking?
Well, if you look at the long-term data, say from 1980 to 2023, the annualized returns were almost identical. The DJIA returned 8.90% per year on average,
Wow.
and the S&P 500, 8.91%.
Wow. That's basically the same. So all the fuss about price weighting is kind of academic then.
In terms of long-term performance tracking the broad market, yeah, you could argue that. It seems those 30 companies, however they're weighted, are just influential enough to capture the overall trend. It's a historical anomaly that somehow still works as a general barometer.
Fascinating. Okay, let's pivot to performance. This new record, over 46,000. Put that in historical context for us. It hasn't always been smooth sailing.
Oh, absolutely not. You have to remember the depths. After the 1929 peak just before the crash, the Dow eventually bottomed out during the Great Depression in July 1932 at, wait for it, 41.22.
41. From a peak of over 380, that's almost unbelievable.
Devastating. And recovery took decades. We've also seen incredible single-day volatility. The biggest percentage drop ever was Black Monday, October 19th, 1987. The index fell 22.61% in one day.
Ouch. But it bounces back, right? Like the 90s.
The 90s were a rocket ship, a 315% gain for the decade. Just phenomenal growth.
But then the 2000s are rougher.
Yeah, the lost decade for stocks. The Dow actually had a negative return for the 2000s, down 9.3% overall.
Really? Negative for a whole decade?
Yep. But interestingly, even then, it did better than the tech-heavy NASDAQ during the dot-com bust of 2002. The Dow only fell about 27%, while the NASDAQ crashed like 75%. So sometimes that old economy mix helps.
And the 2010s brought things back.
Big time. A strong recovery, about 174% gain for the 2010s. And that really set the stage for the incredible run we've seen in the 2020s.
It feels like the milestones have been coming thick and fast lately.
You really have. The Dow crossed 30,000 in late 2020. Then, just in 2024, it blew past 38,000 in January, 39,000 in February, and hit that big 40,000 mark in May.
And now over 46,000 just a few months later. The momentum is strong. Q3 of 2025 alone saw a 5.2% advance.
Yeah, and September was unusually strong, up 5.6% for the month. Year-to-date for 2025, as of October 1st, it's up 9.1%.
Okay, so that brings us right up to October 1st, 2025. Record high close, 46,441 point ounce. Second straight day of records. And this is happening during a U.S. government shutdown.
You'd think so, but history actually suggests shutdowns aren't typically major market movers.
Really? You'd think political chaos would spook investors.
You'd think so, but look back at the last big one, 2018-2019. The S&P 500 actually rose more than 10% during that period.
Huh. So markets just ignore it.
Largely, yes. Investors tend to focus more on the fundamentals, corporate earnings, economic data, what the Fed's doing, rather than short-term political fights in D.C., assuming they don't drag on indefinitely or cause, a default.
Okay, so if the shutdown wasn't the driver, what was pushing the Dow to these records on October 1st?
It looked like specific sectors were doing the heavy lifting. Pharma and healthcare had a really strong day.
Ah, like the defensive plays.
Kind of. Pfizer and Eli Lilly both jumped significantly, like 7% and 8% respectively. This came after Pfizer agreed to lower prices on some drugs after a deal with the White House.
Wait, lower prices made the stocks go up.
Sounds backwards, right? But the market seemed to interpret it as reducing regulatory uncertainty. Like, okay, this is manageable. The worst case scenario is off the table, so less risk perceived.
Interesting psychology. What else was moving?
Technology, unsurprisingly, especially anything tied to AI. Intel shares popped 7%.
Even though they just got kicked out of the Dow.
Yeah, irony there. But the jump was on reports they were in early talks with rival AMD about AMD potentially using Intel's factories, becoming a foundry customer.
Ah, so huge potential demand for chip manufacturing.
Exactly. And other related stocks, like those involved in AI data storage, Micron Technology, for example, also had a strong day.
And wasn't there a crazy IPO story tied to AI as well?
Oh, yeah, that really captured the mood. A company called Fermi. They're developing these enormous AI data center campuses.
Okay.
They went public, and the stock soared 55% on day one.
55%. Was it some revolutionary tech?
Well, here's the kicker. The company has no revenue yet.
No revenue. 55% pop.
Wow. And it's structured unconventionally, too, as a REIT, a real estate investment trust.
A REIT. For data centers, how does that work?
It's a bit unusual. REITs usually own things like apartment buildings or shopping malls. Fermi is positioning itself as owning the physical infrastructure, the land, the buildings housing the AI servers. It's a bet on the physical backbone of AI, structured for certain tax advantages.
But a 55% jump with zero revenue. That really speaks to the speculative fever around AI right now.
Absolutely. Huge appetite for anything related to AI infrastructure build-out.
Okay, so if someone listening is intrigued by the Dow's performance, maybe wants to get some exposure, you can't just buy the index itself, can you? It's just a number.
Correct, you can't buy the index directly, but there are easy ways to track its performance through investment products.
Like what? What's the most common way?
By far the most popular way is through an ETF, an exchange-traded fund, specifically the SPDR Dow Jones Industrial Average ETF Trust. Its ticker symbol is DIA.
DIA. Is that the one they call the diamonds?
That's the one. Been around a long time, very liquid. Buying a share of DIA basically gives you a slice of all 30 Dow companies weighted just like the index. It's a simple way to get exposure.
Are there other ways, maybe for more sophisticated investors?
Oh, sure. The Dow is a huge market for derivatives. You can trade futures contracts, like the E-mini Dow futures. These offer leverage, meaning you can control a large position with less capital, but that also increases risk, of course.
Right, leverage cuts both ways.
It certainly does. And there are also options contracts on the Dow, traded under the symbol DJX. These are used by active traders for speculation or for hedging existing positions.
Okay, so ETFs like DIA for straightforward exposure and futures or options for more advanced strategies.
Pretty much covers the main ways.
So let's wrap this up. We've got the Dow, old, quirky with its price weighting, concentrated in just 30 stocks, some of which are maybe
I
surprising.
think Goldman Sachs having more clout than Apple, yeah.
But despite all that, it keeps hitting new highs, it correlates strongly with the broader market over time, and it's being driven currently by specific sectors like pharma and the ongoing AI boom.
That sums it up pretty well. The structure is weird, but the performance, especially recently, is undeniable.
What should we be watching for next? Any thoughts looking ahead, maybe based on historical patterns?
Well, one interesting historical tidbit, especially as we're heading into the final stretch of 2025. The fourth quarter tends to be seasonally strong for stocks.
Ah, the Santa Claus rally idea.
Sort of, but it's broader than just December. History shows that when the S&P 500, which remember tracks closely with the Dow, is already up for the first 9 months of the year, like it was in 2025,
Yeah.
the fourth quarter sees positive returns about 89% of the time.
89%. That's a strong tendency.
It is. Doesn't guarantee anything. Obviously, past performance isn't predictive. But historically, Q4 has often been called the most wonderful time of the year for stocks, especially after a positive start to the year, something to keep in mind.
A fascinating historical pattern indeed. So the Dow's at 46,000, and maybe history suggests the momentum could continue. That's definitely a provocative thought to end on. If you found this look at the Dow and what's driving the market useful, you might want to check out our other deep dive exploring the massive economic impact of AI infrastructure spending next. Thanks for joining us for this deep dive.